Hey guys, in this video we're talking about what shifts the AD curve, the aggregate demand curve, otherwise known as the total spending curve. That's right, aggregate demand is total spending. So what we're talking about in this video is what causes the AD curve, the aggregate demand curve, to shift to the right, which means total spending to increase at every price level. Or what would cause aggregate demand to shift to the left? Total spending decreasing at every price level. Now, to answer this question, what causes AD to shift right or shift left, we need to talk about two things that are really important about answering this question. Number one is when you talk about aggregate demand, guys, I really want you guys to think down one level. See, aggregate demand is just that, an aggregate. Instead, get down one level to the type of demanders of goods and services there are in our macro economy. And there are four types of demanders of domestically produced goods and services. What are those four demanders? Households. And households give us consumption spending, okay? Businesses give us investment spending. Governments give us government purchases, and the rest of the world gives us net exports. That's right. Our different demanders, the demanders that we are aggregating together when we talk about aggregate demand, are households, businesses, government, and the rest of the world. And when each of those demand goods and services, they spend money on those goods and services, and each of those spending types that they do have their each individual name. Again, household spending is consumption. Business spending is business investment. Government spending we call government purchases. And when the rest of the world spends money on our goods and services, we call that export expenditures. Now, of course, to get aggregate demand, total spending on domestically produced goods and services, we have to subtract out the imports. And that's why at the very end, we don't just put exports, we put net exports, because we got to subtract out those imports. So again, when answering this question, what shifts the AD curve right or left? The first thing is don't handle aggregate demand at the aggregate demand level. Get down one level to who are each of those demanders out there. The other thing is when you talk about aggregate demand or total spending changing at every price level, we need to realize that it's exogenous factors to the graph, okay? Exogenous variables to the graph that are going to cause the curve to shift, okay? These things we call shocks. That's right. These exogenous factors out there we call shocks. And here's the deal. They are exogenous. They aren't part of the graph. So what we're really asking is the following when we talk about AD shifting. We're asking what other than the price level, the endogenous variable, what other than the price level would cause household spending to change, or business investment to change, or government purchases to change, or net exports to change? What other than changes in the price level would cause each of those to change? So let's get to it. Let's answer the question. Again, down one level from that aggregate demand level to the different demanders of goods and services, households, businesses, government, and the rest of the world. So let's start off with households again. And yes, the C is for consumption, which is just another name for household spending. So what would cause household spending to change other than the price level? Well, guys, there's some easy ones out there. Number one, I think kids should think about is current disposable income. I'm just going to put DI, disposable income, current disposable income. Now, there's a few things that change disposable income that are very important in a macroeconomics class. One of them is taxes, right? Which of course is a lever of fiscal policy. That's right, taxes is a lever of fiscal policy. The other one is transfer payments, right? Transfer payments. Some people might call these government transfers. Same thing. This is your Social Security, your unemployment compensation, things like that. So transfer payments. Now, what else other than the price level and now disposable income changes household spending? Of course, the next one I think that students should think of is wealth. I mean, if we've got income, we also need wealth. Income being a flow and wealth being a stock, okay? Now, what are the two types of wealth, household wealth, that we should really keep our eyes on? That would be housing prices, okay? So look for what's happening to housing prices generally in your economy, and also the stock market, right? What's happening to the prices of stocks in your economy. If either one of those change, the wealth of households is changing. What else, guys? consumer confidence. Now, that name can take different forms. In the textbook I teach from, it is called Expectations About Future Disposable Income. Guys, that is consumer confidence, right? The confidence that consumers have in the economy. That's all that is. Now, what else is there out there? Definitely the interest rate, right? The interest rate is going to affect consumption to some degree. So those are some of the major things that are going to change consumption out there, or household spending, that are not the price level. They're exogenous to our model, so they would cause shocks. They would cause the AD curve to shift. What else besides the price level is going to cause business investment to change? Businesses to demand a different amount of goods and services. Well, number one for business investment we have to start with is the interest rate. Now, there are actually 3 types of spending that are sensitive to the interest rate. We already have 2 on the board. Consumption, sensitive to the interest rate. Business investments, sensitive to the interest rate. And we'll find out net exports, also sensitive to the interest rate. But guys, the most sensitive to the interest rate out of those 3 types of spending is probably investment. Okay? So 3 types of spending that are sensitive to the interest rate. The most sensitive is investment. The next one, guys, is business confidence, which in my class, I might teach that as businesses' expectations about their real rate of return of their projects, right? The business expectations about the real rate of return of their projects. If businesses become more confident, they're going to adjust those expected rates of return upward. So we'll now do more investment, okay? And every single interest rate is the way we would say that, but we're going to do more investment spending if the expected real rate of return of business projects goes up. Finally, the degree of excess capacity. Here's the thing, guys. If businesses are almost at full capacity, then they are much more likely to do an investment project. If businesses have a lot of excess capacity, they are much less likely to do a business project. So, degree of excess capacity. The less excess capacity, the more likely we are to see businesses doing investment projects, all right? Government purchases. That one's simple, guys. The only thing that causes government purchases to change is legislation. That's right, legislation by our legislative body, oftentimes signed off by the executive branch, i.e. the president in the United States, okay? So legislation, that's all there is for government purchases, really simple. Net exports, we're gonna have 3 things, okay? The first one, guys, is the national income of our trading partners, okay? So of our trading partners, a lot of abbreviations up here, okay? National income of our trading partners. Guys, if our trading partners' national income goes up, they're gonna buy more of our stuff, they're gonna buy more exports, AD is gonna shift to the right. Next, guys, would be the value of the domestic currency, right? So the value of the domestic currency. Pretty simple, guys. We're just talking about, we make the United States the domestic country, so our currency is the dollar. If the dollar depreciates in international exchange markets, if the dollar becomes cheaper, well, our goods and services are priced in dollars. So if the dollar becomes cheaper in international exchange markets, since our goods and services are priced in dollars, our goods and services have become cheaper to the rest of the world, okay? And so the rest of the world is now going to buy more of our goods and services. So that's right. If the dollar depreciates, exports go up, right? Exports go up, and imports, by the way, do go down, which both cause AD to shift to the right. Now, finally, the last one, guys, and I kind of already foreshadowed this, is interest rates also do change net exports, okay? So a quick one on this. There's many other videos I have to explain this further, but just quickly, guys, if the interest rates go up domestically, the rest of the world is going to want to put more of their financial capital in our financial markets. And to do that, they're going to have to demand our currency, right? So that's right. If our interest rates go up in our financial markets, the rest of the world says, oh, I want to get more of my financial capital into those U.S. markets. To do that, I'm going to have to demand the dollar. When they demand the dollar is going to appreciate. Oh, well, if the dollar appreciates, and our goods and services are priced in dollars, well, that's going to make our dollar more expensive, which is going to make our goods and services more expensive. So guys, here's the thing. If that interest rate goes up, we're going to see less demand for U.S. goods and services. Exports is going to go down. Really quickly, one more time, interest rates go up. People want to put their money into our financial markets. To do that, they're going to have to get our currency. They're going to demand the dollar. When they demand the dollar is going to appreciate. That means the dollar is going to become more expensive, which is going to make our goods and services more expensive. Exports are going to go down. So if interest rates go up, exports go down. AD shifts to the left. Now, that's it. Those are our determinants of AD. Never try to memorize the determinants of AD. Instead, go down one level from aggregate demand to consumption, investment, government purchases, and net exports, and just think to yourself, what other than changes in the prices of goods and services, the price level, is going to cause each of these types of spending to change? And I want you to get to the point that this is absolutely common sense. Yeah, this is common sense. Not a big thing to be memorized, something that could be understood. And as I leave you guys, I just want you to take a look at this little graph right here, okay? Now, what's happening when any of these things change, which is something other than the price level, is one of these components is getting bigger at all price levels. So let me just put in real quick, price level sub 0, price level sub 1. So two different price levels. Imagine one of these things changing so that consumption increases. And what we could imagine consumption doing if these things, exogenous variables, cause consumption to change, is consumption is going to increase at every price level, right? Of course, if something other than the price level changes, well, consumption is going to increase at all price levels. Again, AD shifts. If one of these things, which are something other than the price level, changes, right, investment is going to change, right? Maybe increase or decrease. Let's just say increase at every price level, again, causing AD to shift. If something other than the price level causes one of our types of spending to change, the AD curve is going to shift. We're going to get more total spending at every price level or get less total spending at every price level. I hope that made sense to you. We'll see you in the next video.